joining us for our webinar presentation on estate planning and life insurance. We're really excited to have two of our experts on with us tonight. You'll hear tonight from Shannon Switzer and Bijan Nouri, and of course myself as well. This is Kristen Tabar, and I am a realtor and real estate advisor with Marshall Reddick Real Estate. So let's jump right into tonight's presentation. We've got a lot of great stuff to cover. As I mentioned before, I am an investor and a real estate advisor with Marshall Reddick. My husband and I own property across 4 of our markets. I've been with the company going on 5 years now, and in that time, I've worked with 285 buyers and sellers to help them acquire and sell their homes or rental inventory. And of course, you can see my family right there. My son is almost 5, my daughter's almost 2. This is a little bit of an older photo. But a lot of us have different reasons for wanting to invest and for looking at, making sure that our insurance policies are up to date and making sure that our assets are safe and planning for our estate. And they're my reasons right there. So I like to have that photo there so everyone can get a little bit of an insight into me and what I'm all about. And let's move right along. Some of you are joining us for the first time. And so here's a little bit of information in a nutshell about Marshall Reddick Real Estate. We are a full service brokerage here in Southern California with offices across the nation in Austin and San Antonio, Texas, Clarksville, Tennessee, and up and down the California coast. And in addition to helping our clients buy and sell property, we manage property as well. So all of our clients who purchase rental inventory, we're able to help them manage. And we also provide our clients an opportunity to be the bank or borrow non-recourse money from us. So that's all the services that we provide in-house. In addition to our in-house services, we also have a Rolodex of professionals and vendors that we can refer our clients to for anything that they need for a real estate transaction, whether it's a insurance provider, whether it's an estate planner. Like I said, we're going to talk about that tonight. A lender, if you're looking at a 1031 exchange, etc. This is what a lot of our clients like and why they prefer to work with us is because we can help make all these connections and get you in touch with the team that you need for a successful transaction. And not only a successful transaction, but to have success for the life of your investments. Here's a quick snapshot of our market. I did mention a few where we actually have a Marshall Reddick office. You'll see those outlined in red. The other areas are where we are working currently with third-party agents and management teams. The good news is eventually we won't need the red boxes because we'll have an office everywhere. So we're really excited about that. We can help our clients in 16 major markets across the nation. So we really have something for everybody, and we're able to help a lot of people because of that. So as I mentioned early on, I am an advisor with Marshall Reddick Real Estate. Part of our benefit to our clients is that we offer mentoring and advice for all of our clients, regardless of what phase you're in, if you're just getting started, if you already own property. So here's a quick snapshot of what you can expect from your free consultation with your advisor. We want to find out the who, what, where, when, why, and how of your own personal real estate goals. Everyone's criteria is unique. Everybody's situation and long-term and short-term goals are unique. So what we want to do is set up a plan for you to help make your portfolio scalable and help it work for you in the ways that you want to, whether you're looking at early retirement, whether you're looking to supplement an income, or whether you just need something to do during the day because you're retired and you'd like to manage some properties and manage your managers. So there's something out there for everybody, and we want to be able to help you find it and put all the pieces in place for you. And why is that important? Like I said, we want to help everybody make a scalable portfolio. One property, folks, does not make you a millionaire. You're not going to be able to retire on one property. So what we want to do is help our clients to build something that can help you achieve your goals. So that might look something like this. This is my husband and I's personal real estate portfolio. You can see that we've purchased several properties, we've sold a property, And we've also done a couple of hard money loans through Marshall Reddick Real Estate and our private lending department. This creates a little bit of diversification. You can see we're in several markets. And this roadmap was made possible because we talked about what our goals were, talked about what we wanted to do and where we wanted to end up, and we're able to put together a plan to get here. So once you have a portfolio and you have several properties and you own several assets, it's important to make sure that those assets are protected. So I am going to introduce Shannon Switzer. She is an estate planner with Creighton Switzer Tokar Attorneys at Law. She's been a partner with Marshall Reddick for several years and has worked with many of my clients to set up their trusts, make sure that everything is in order, and really get them situated to know that their assets are protected and give them the comfort of knowing that regardless of what happens, their family is going to be protected as well. So Shannon, without further ado, I would love to have you hop on and take it away.
Great, thank you very much. Today's discussion is just basically a primer on the different ways that we can transfer assets after death. So planning an estate is really just addressing the issues of asset transfer and the way to impart any kinds of values or conditions that you might want put in place if you're not here in order to be able to affect and enforce those concepts. So let's take a look at some of the basics. This is just a little bit of information about me. I am an attorney and a partner at the law firm of Creighton Switzer and Tokar. We are based in downtown Long Beach, but service clients throughout California. I am very proud to say that I am a professor at Chapman University's School of Law as an adjunct, working with students doing estate planning coursework. So that's a great sense of accomplishment and a great enjoyment for me, along with my day job. So that's just a little bit about me. Not the most exciting stuff. So estate planning information. Want to just give you some alternatives to what happens when you die with your things. How do they get transferred and in what method? Essentially, there's only one of three ways to transfer assets when you pass. And that is either with no plan in place, no writing, no nothing of any kind, and they call that dying intestate. Then there is a will that stands alone, and that is a public process that goes through the courts. And there is a third alternative, which is a trust. Living trust is the common term you'll hear people call it. Its correct name is actually a revocable trust. And of course, there are irrevocable trusts as well. But for core estate planning, these are the three options that we focus on. So when we talk about estate succession, basically what we're saying is there's nothing in place. So your estate and your assets will go by default. So it's really the government and whatever they put into the probate code that decides who inherits your assets. Obviously, from a planning perspective, that's not much of a plan. Generally, you'll find that intestate succession rules are based on blood relatives. So other than a spouse, the people that the government thinks should naturally inherit your things would be children, your parents, your siblings, etc. And that is certainly not always where you would like to see your assets go. So intestate option is certainly not a plan from our perspective. So that leaves us with really two tools, and that is either a will that stands alone or a trust. So let's talk about the distinctions between the two, and then we'll compare both the advantages and disadvantages of those different tools. So since the will is just an instruction that is ultimately overseen by the court system. So the infamous probate that you hear so much about is the very system that we're talking about. So probate is a division of the court that's going to oversee your will. And it's going to attempt to ensure that all these formalities are filed for the purpose of making sure what you've articulated in your will is actually what happens. So some would argue that the upside to having a will that goes through the probate process is that it's overseen by the courts and therefore is presumably more likely to be enforced and less likely to have any sort of shenanigans behind the scenes. The downside to the probate process is that in California, unlike many other states where the lawyers actually just get paid by the hour for their time, in California we have mandatory fees that are paid both to the lawyer and to the executor, the person you've appointed as the person who will marshal this through the process. So those mandatory fees are actually based on the value of the assets in your estate. So it has nothing to do with how much time or effort you put in as a lawyer. It's strictly what you've been able to acquire during your lifetime. So many people find that objectionable. So it's just a matter of where your preference lies. So taking a look at those advantages versus the disadvantages. I just highlighted a disadvantage, and that's the funds. But an advantage is that it costs us a little bit less money from legal time and perspective to set up a will-based plan because there are less documents and moving parts. So in that situation, you'll save a little money on the front end with the lawyer. During your lifetime, a will is a bit simpler to administer in that we create the will, we properly put it together, and then it goes in a drawer and it stays there until somebody needs it when you pass, or something comes up and you change your mind and it needs to be adjusted or replaced. And arguably, the point I was highlighting earlier is that the court's participation and oversight is certainly going to be the gold standard as far as ensuring that what you've articulated in your will is actually what is ordered and is happening. So those are the advantages of a will. The disadvantages of the will is that the probate process is a public process, meaning that you go to court and you have to sort of lay bare, for lack of a better term, the will itself, all your creditors, etc. All of that is going through the court system, being reported to the courts and accounted for with the courts. So there are some people who don't want that to be an element and find that less desirable. By far and away, the most critical factor, I think, for most people is the expense. So again, as I mentioned earlier, the value of the assets that you pass with is what determines the fees that get paid to both your executor and the lawyer who takes this thing through probate. And just to give you an example, it's $46,000 for the first $1 million worth of assets in fees. That's $23,000 to the lawyer and $23,000 to the executor. So that's just an idea of one of the disadvantages because it has mandatory fees. And then the timeline that it takes to get through this process. On paper, if you were adhering to the law and the codes and the timelines required to probate a will, you could actually get through a probate in 9 to 10 months. However, we can't actually get through probate anywhere between 18 to 24 months is about the going rate now. Because our courts are so impacted, there are so many people here in California, and we simply can't get court times, process times, etc. So the average probate is an 18-month to 24-month turnaround time. So that entire time, the probate process is sitting in the court system. So the delays there are definitely a 9 to 10-month window, but really, in practicality, are more like 1.5 to 2 years. And so that is not considered ideal versus the concept of being able to step in and do this work under a trust as an alternative. So let's take a look at that tool. So when you think of the will as the public process, and the trust is generally the private process. So to make a point of clarification, when I'm talking about a will versus a trust, what I'm really talking about is a standalone will that is the core document for your plan versus a trust with a companion will. So what I mean by that is every revocable trust, so the core trust we're talking about today, should have with it a companion will. And we call those wills pour-over wills. That's just a term of art, and it comes from the concept of pouring over into the trust. And basically what that will says is, hey, if I've inadvertently left anything in my individual name, gather it up and put it into my trust so that it can be distributed according to my wishes under my trust. So part of this process that we'll talk about in just a minute is the fact that you have to take your assets and put them into your living trust. And sometimes along the way, people mess that up. They take it out, they don't get it put back in, they acquire a new asset, it doesn't get properly funded into the trust, whatever it might be. The pour-over will is the catch-all. It's the CYA, for lack of a better term, that will catch any assets that are left in an individual's name, and it will put them into the trust. However, you will still have to go through probate to get those assets into the trust if the assets total more than $166,000 in 2020. That's the number. So it's not ideal, but it is meant to be a catch-all in the event that something were to be inadvertently left out. So when I say a will versus a trust, what I really mean is a will versus a trust with a companion will. So just to clarify, for those of you who have plans in place or already in the know as it relates to that concept. So let's talk a little bit about the trust itself. A trust is just a contract that has participants and parties to it. So when you create the trust, you are the creator of the trust, and we often call those the settlor, the trustor, or the grantor. They're all interchangeable terms, and at the drafter's discretion as to what they use. And then the person who is in charge of the trust, managing the assets, doling out the money to the beneficiaries, that is the trustee. Now, most commonly, if you're creating a trust yourself, you are also the trustee. So you are both the settlor and the trustee during your lifetime, as well as the third hat, which is the beneficiary. That's the recipients of the assets held by the trust. So, for example, in my case, if I had my core revocable trust, I am the settlor of the trust. I created it. I am the trustee because I'm in charge of it, and I'm the beneficiary during my lifetime. It's my stuff, and all I'm doing is shifting it into this trust for the purpose of effectively and cost-effectively transferring this after my death. So, of course, I want to be in control and benefiting from all the things I own. So those are the parties, and you're going to wear all the hats, presumably, at the onset, but it's after you're gone or I'm gone that somebody steps into the role of successor trustee, the next person in line. And it's after we're gone that we have named the next beneficiaries, the successor beneficiaries. So during my lifetime, I'm wearing all three hats, and then I pass, and the successor trustee will be my spouse or my parent or my best friend or a professional, whatever lays out for you. And the recipients would be my children or my nieces and nephews or my parents or whatever you've got, any charitable organizations, etc. So that shift in dynamic is already set up into the trust and will occur as a function of law on my passing. So the reason that you'll see in the compare and contrast for advantages and disadvantages that a trust can be a little more burdensome is that we have to both create the legal document, just like we do with a will. But unlike with a will, we actually have to transfer the assets into the name of the trust. Not a big deal. You'll become accustomed to that as you acquire new assets. But it's critical that everything you own be titled in the name of the trust in order for it to be properly funded. So if we create it, but we don't transfer title into the name of the trust, we haven't given it dominion over your stuff. So funding is the second step to creating a trust. So a new grant deed for a piece of real property, transfer the name on the bank account from my name to my name as trustee of my trust, etc. So that's the process for creating the trust. It's 2 steps instead of just 1. So that leads us to the concept of the advantages and disadvantages of the trust. So the advantages are that we get to skip that whole court process. So we get to skip any kinds of mandatory timelines or delays, and we get to skip the fact that we're going through this public process and being governed by other people's timelines and schedules. It's also less expensive for the heirs, the beneficiaries. So where we talked about the fact that there were mandatory fees based on the value of your estate for probate, that is more expensive for the heirs. It eats into what ultimately they are putting in their pockets by reducing what you're giving away. The living trust, the expenses related to administering the trust are simply the time it takes for legal professionals, tax preparers, etc. You're simply going to pay them for the job they do. So as a whole, it's generally much less expensive for the time and efforts of the attorneys, etc., to be paid by the hour than it is to be paid as a percentage of your estate. And then again, we eliminate the delays that come with having to be beholden to the probate court in their process. Now, keep in mind, you don't just flip a switch and all of a sudden all of this stuff under the trust is now in someone else's name. It isn't that quick. There are, of course, legal requirements that when someone passes, we have to give notice of the trust and do a handful of things to make it legitimate and effective. But for the most part, on day 2, somebody could become the successor trustee that you have named and step in, at least manage assets and dole out money and do those kinds of things for an ongoing maintenance if necessary. Disadvantages to the trust are some of the things that we just talked about a moment ago, and that is that we have to actually do the 2-step process of both creating the trust. So legally, we create the trust document, and secondarily, then we have to fund it. So there's a little bit of time and effort that's going to go into that wouldn't otherwise go into a will, and therefore it's going to be a little more expensive on the front end for you. You got to pay the lawyer the extra time it takes for the funding documents, etc. But we're talking, hundreds of dollars versus potentially thousands of dollars in fees to the probate court. So that's a balancing act there. The nuisance factor during your lifetime. It is a little bit more burdensome to make sure that everything you acquire is actually in the name of the trust. So instead of you buying something and putting it into your name, you purchase it, your name as trustee of the trust. It's really a simple concept, and I assure you that it comes pretty naturally after a while, but you do have to get accustomed to that. So there's a nuisance factor of having to make sure that everything is titled in the name of the trust and that it stays there. Because as we discussed earlier, if it isn't in the trust, it can't be governed by the trust. And then the possibility of mismanagement. So one of the arguments that people would say is an advantage of going through the court process and having a will is that the courts and the judges will ensure that what you've indicated in your document is in fact what actually happens. With a living trust, this is a private document. So there's no overseeing entity. The trustee that you have empowered to do this job is on their honor to do that job and administer the funds, etc., as you've instructed them. Now, I would argue that the real check on the person who is administering the trust, the trustee, are the beneficiaries. So I can assure you that if I were a beneficiary, I would keep my eye on the trustee and make sure that I was well enough informed to know what was there and what I was getting. So I think that, again, there's a balancing act between risk versus reward as far as cost and time. So those are the advantages and disadvantages in the compare and contrast of a trust versus a will. Now, one of the concepts that we need to talk about, and one of the core things that we look at when we do estate planning, is something called the federal estate tax. You might pejoratively hear it called the death tax. And that is basically the concept that when you die, you can give away as much money as you want up to a certain dollar amount tax-free. And every dollar you give away after that is taxable by the federal government. That is the estate tax. Now, today's numbers are the largest we have ever seen. They are very big. So you'll see the number on the screen in front of you, which is $11.58 million. That is the amount that you can give away at death with no taxable consequence. Every dollar you give away after that is taxable at 40% flat tax to the federal government. So in the event that this is applicable, it can get very expensive to have to worry about the estate tax. But notice that it says that this law sunsets in 2026. So the current tax code that has created this $11.5 million exemption number actually has a base value of $10 million exemption, and then it's calculated for increased inflation. So every year it changes a little bit. In 2026, it's scheduled to go back to a $5 million base instead of a $10 million base, because prior to 3 years ago, that was the base. Let's see, I'm trying to think of years, but let's say 5 years before that, the base was escalated. It went from 2 million to 3 million to 3.5 million, etc. This number is purely set at the whim of Congress. So we never, as planners, know when someone dies what that number is going to be. All we can do is have the best plan in place to use the full exemption amount when someone passes. So you want to be in a place that you are using all the tools of the trade to make sure that you're taking advantage of this exemption. So we'll talk about that a little bit more when we talk about spousal relationships. But the idea behind the estate tax is one of the driving forces that we talk about when we're talking about estate planning. So here's what we need to consider when we're talking about those exemptions as it relates to married couples. So two spouses and registered domestic partners as well. You are able to have an exception to the rule that we just talked about, the maximum estate tax exemption amount, the $11.5 million. Every dollar after which you have to pay tax. Well, the exception to that rule is if you give assets to your spouse. So if you're the first to die and you give all of your money to your surviving spouse, you have triggered no estate tax no matter how much money you give your spouse. And there'll be no taxable consequence on your death. Unfortunately, what that means is if your spouse were still to have a significant amount of money when they died, the survivor, they only have one estate tax exemption to use on their death. So if we took everything of yours, the first to die, and piled it into everything of the survivor, and then they died, we've doubled up the survivor with assets, assuming they haven't spent them all, and now they only have one estate tax exemption. So they can only transfer the $11.5 million. Again, these are very big numbers, but I can tell you that when I started practice, this number was $600,000. So a piece of real property in California could potentially put you over that number. So we have to plan for the unknown number and using the exemption to the best of our ability. And that is where marital trusts come into play. So you'll see on the screen that there's a mention there of an ABC or an AB trust. Here's essentially what that means. If we have a revocable trust in place, and actually we can do this with a will as well, when the first spouse dies, we can say, hey, take my assets and put them into a sub-trust. We're going to call that a B trust, a bypass trust. So if you take the assets up to the amount of the exemption number, the $11.5 million in today's numbers, and you put that into a B trust, a bypass trust, it can be for the full benefit of the surviving spouse during their lifetime, and then you say what happens to it, whatever's left over after the spouse is gone. By doing that, we have safeguarded the first person's estate tax exemption, and the surviving spouse has their own estate tax exemption, and they have their own half or pot of the assets from the marriage. So let's say that you owned everything together as community property in California. That means half is yours and half is your spouse's. if that's the case and you have $10 million, then that, if we split it in half and $5 million were for the survivor and $5 million were for the first to pass, $5 million would go into the bypass trust on the death of the first person, and $5 million would go to the survivor, likely in a survivor's trust. But then when the second person passed, they would be able to transfer the assets, both the survivor's pot with their own exemption amount and the first to die, the decedent's pot, with their own exemption amount. So those numbers don't work with this particular estate tax exemption. Let's say you had $30 million and it's split in half. $15 million would go to the B trust. Excuse me, that's really not true. $11.5 million, the full estate tax exemption, would go to the B trust. And the $15 million of the survivors would go to them. And then you'll note that there's a C trust note there. That is anything in excess of the $11.5 million that's going to the B trust that belonged to the first spouse would go into a C trust. We won't get into all those layers. But the point is, by splitting this thing and creating both an A and B trust, we're able to safeguard the first person to pass's exemption as well as the second person to pass. Then when the surviving spouse does pass, the B trust will distribute, let's say, to our mutual children, and the survivor's portion will distribute to our mutual children. And now we've been able to give away $22 million, so 2 estate tax exemptions, tax-free, instead of taking that same money, piling it all into the pot for the survivor, and only having an $11 million exemption with which to give away our $30 million. So we've doubled up the ability to use the exemption and safeguard from tax what we're giving to the next generation or to the next recipients. So for married couples, it's important that you have a good thought out plan in place that we can talk through and make sure we're using or giving the option to use both of these tools, both the B trust, a bypass trust, and the survivor's trust that will go with their estate. So that's something to think about and something that's going to be very important in planning for couples. Practical information. After you form and fund a trust, for example, or even if you've created a will and you've put it into a drawer, you want to be sure that somewhere, this is just purely a practical functional element of what we do for estate planning, but often it gets overlooked amidst all the legal stuff. And that is that if you actually pass and other people don't know all of your assets, where to find them, how to access them, etc., it's very helpful. In my recommendation, I actually recommend that you pick a date, something that will trigger you, whatever it might be, an anniversary, a birthday, something less fun, whatever it might be. And you actually wanted to use that as your triggering date to just create an annual asset listing and update that listing and include in there the ability to find or get access to records. So in today's world, there's technology that actually allows you to electronically store all of your asset lists with companion passwords, etc., sort of safely and privately. Old school, I've just got a list that I keep in a secure drawer, etc., where my people know, hey, here's my annual asset listing, here's how you can access it, here's some password information, etc. Certainly, the more savvy you are electronically, the better off you'll be going forward with some kind of a list. But the key is that if I'm your successor trustee, or if I'm your executor for your will, I need to know what you have and where to find it. And that's something that just as a practical matter gets overlooked all the time. Also, as part of our planning, we often include a clause in the trust or in the will that says, hey, I'm going to leave a memorandum of personal property items that I would like distributed according to my instructions. So by incorporating that into the document that we draft, we're able to give you the flexibility to change your mind about where you want items of personal importance to you that are not titled assets. So if it's a Picasso, we're going to want to call that out specially in the actual legal documents. But if it's the painting that you did that's particularly special to your grandchild or somebody in the family, we can put that in this letter and say, give the, XYZ item to so-and-so. And we incorporate that by building just a plan into the legal document and allowing you to have this personal property letter. So we want to make sure that you take a look at that along with your asset listing if you've built that into your plan. And then also if there's any kinds of, instructions that you have put into play for your agents regarding, burial or services, et cetera, you'd want to take a look at that. And then you want to be sure when we put this plan in place and create these legal documents that you let the people know who are your successor agents, who are your successor trustee, et cetera, that they are informed of their role and that they know where to access all of this information. And I know this sounds completely intuitive, but it's one of the things, these basic concepts often get overlooked in the big picture discussion of marital trusts and, distribution, et cetera. So it's just a practical way of making sure that you're thinking about these big picture items. One of the planning techniques that has come up much more frequently as of late, I think we have a generation that is aging into a much larger group of people. Our boomers have hit the age where they are now, such large numbers are in the aged category. And we are seeing all kinds of issues with needing help with things like people suffering from physical ailments that require assistance and people suffering from mental ailments like dementia and Alzheimer's. And those kinds of things are putting a new dimension in place for planning considerations. And that is that there are expenses and concerns about depletion of assets, caretaking for myself, how am I going to be taken care of, et cetera. One of the things that's come into play and certainly had more options and more affordability over the last decade is the idea of long-term care insurance. And I think in today's society with an overly burdened public system and a system that you rarely would qualify for if you had any assets, long-term care insurance will fill the gap for people who are in need of essentially in-home care or nursing home care in some capacity. They have all kinds of hybrid versions of this thing that is both long-term care and has a life insurance component. I certainly don't know enough about it all to speak effectively about it, but I think it's one of the most important things that is another area to be highlighted in consideration for estate planning, is to be able to get in early enough that you are eligible to have long-term care insurance. In the event that you need it, it could be the difference between how you're housed and cared for and whether or not you have enough money to survive and live on during a lifetime, let alone being able to give anything away after death. So that's a consideration that I think everyone should be talking about now as part of their estate planning considerations. One of the other things that we like to highlight is the fact that in your gross estate, when you die, you would be surprised how many things are included as, quote, part of the gross estate for the purpose of estate tax. And included in that, so it's not just what you have on paper, it's all kinds of additional items, but included in this concept are the proceeds from life insurance. So if I die and I've got $3 million worth of assets, real property, investment accounts, et cetera, so that right there, they're actual assets, hard assets on paper. And if I also have a life insurance policy worth $1 million, the federal government says that my estate for the purpose of taxes is $4 million. The $3 million I actually have and the additional $1 million that I gave away via life insurance after my death. So what we don't want is to have a life insurance policy payout and have that kick you into additional estate tax. So one of the ways to eliminate that is to remove the policy from, quote, your estate, that means your dominion and title, and shift it from being you, the owner of the policy, to an irrevocable life insurance trust owning the policy. It takes the funds out of your estate for the estate tax application, and therefore they don't count against you, so to speak. So an irrevocable life insurance trust is simply another form of trust that we transfer the life insurance policy into, and during your lifetime, it will hold the policy. After your passing, it will receive the proceeds and pay them out to whoever you've designated to be the recipient. So again, it's just a tool for the purpose of taking it out of your estate for estate tax purposes. So it's something to consider if you have any significant life insurance policies. Here's just a quick overview of what you'd like to see in a collective plan. So if we're going to say that this is a trust-based plan, then you would need the trust itself, that companion pour over will we talked about, and two very important documents. And everyone should have this, whether you are a will-based plan or a trust-based plan. The two lifetime documents that are critical are an advanced healthcare directive. You might also hear that called a power of attorney for medical care, and a durable power of attorney for assets. These are documents that are effective while you're alive, but if you become incapacitated. So one gives guidance. The healthcare directive will name an agent, someone who can step into your shoes to make medical decisions for you. And included in that directive can be your guidance as to what you want to guide them for as it relates to end of life choices, extraordinary measures, etc. So for example, mine says, if I have no brain activity or I'm in a terminal state, please don't artificially keep me alive. Obviously that's paraphrasing, but that's my choice and that's my guidance to my agent. Whereas yours might say, do anything medically possible to keep me alive. Those are two different forms of direction, but I'm giving that to my agent to step into my shoes and do my bidding. What we don't recognize necessarily, because societally we don't think so much about that, is that there is nobody who's enabled legally to step into our shoes, either for making healthcare decisions or accessing assets or making choices related to our stuff, the things we own, if we haven't given them some sort of legal authority. The only alternative to stepping into our shoes and having this is to go to court and get a conservatorship. So a conservator lets somebody step into the shoes of another person and make decisions for their person, healthcare, etc., and for their assets. Absent a conservatorship, nobody has the authority to do either of those things for you without one of these documents. And conservatorships are time-consuming and expensive, so the only people that win there are lawyers. And you probably need the ability to make these decisions quickly if we're talking about healthcare, and conservatorships are probably a 4-month process in the court system. So for a few $100 in drafting these things to the lawyer up front, you can have put in place someone who can step into your shoes if you become incapacitated. So that could mean physically incapacitated. I've been hit by a bus and I'm in a coma. Someone's got to step in and make choices for me as it relates to my health care. If I remained there for an extended period of time in that state, someone would have to pay my bills or manage my assets, etc. So those two documents provide for that effectiveness. Now, if I wake back up, I'm back in charge. So this is only in effect if I need someone to step in because I'm incapacitated. But where we find more and more the need for both of these documents is that so many people now are suffering from some form of dementia. As our population, again, is aging, we're finding more and more that people are being treated and diagnosed with dementia conditions of some form. Once that's the case, and you reach the point that you are suffering mental incapacity, we can't put these documents in place at that time. So the only alternative for someone to have this authority is to go to court and get a conservatorship. So we don't want to be penny wise and pound foolish. You always want your plan to include both of these documents. Really important. And then if applicable, we would do the life insurance trust. And if you're married, you want to consider some sort of spousal property agreement, which reflects the character of the assets that you own. Character is important when you have a trust because it's going to determine how we split those assets on the death of the first spouse. It also determines what goes where, so that if you have a blended family of some kind, or you have spouses with different interests for after when they're both gone, where their assets go, you're going to want the character to be reflected somewhere. So those are sort of an overview of the big picture. If you had a will-based plan, you would eliminate the trust on the top, and you would have a will and all the documents that reflect below as well. Okay, so that is a speedy overview of some tools and considerations for a primer on estate planning. I hope that that helps at least to get ideas flowing for you as to, where you want to head, ask some more questions, do those kinds of things, and feel free at any time to email me or call me with any questions that you might have. I'm happy to answer them and see if we can't head you in the right direction.
Thank you so much, Shannon. It's always a pleasure to hear any updates and get a refresher. There's a lot of moving pieces definitely with setting up a will or a trust or anything like that. So I definitely encourage you guys to reach out to myself or Shannon with any questions. Also, please feel free to type questions into your question panel and we will make sure to get those questions answered for you as well. I want to go ahead and jump into our next topic now and introduce you guys all to Bijan Nouri. He is going to talk to us about protecting ourselves and our families and our assets with life insurance and how that works and what you guys need to know. So Bijan, I'll let you take it away from here.
Hi everyone, my name is Bijan Nouri. I am the owner of Bay Point Insurance Services. Our insurance markets include policies on life and health, that end of the insurance spectrum, from individual life insurance, long-term care insurance, disability insurance, to group benefits that encompass a wide range of products. My portion of the webinar today is going to go over going to focus on protecting your real estate portfolio for generations by including insurance stop losses as part of your overall planning. I call this protecting your empire. A little bit about myself. I'm married. I have two little girls, ages 11 months and 3 years old. I graduated with a degree in finance in late 2007, just as the real estate and equity markets were about to explode. And I've been in this insurance business since July of 2008. A really tough time for a lot of us, the real estate market and equity markets crashing. When I tell people I'm an insurance broker, usually their eyes glaze over a bit. So I also love to tell people that I'm an avid snowboarder, mountain biker, things to make me seem a little less boring. And lastly, something you should know is that I am a mini real estate mogul, thanks to my friends at Marshall Reddick. About 3 years ago, I was speaking to a new client about how he and his brother had built such a robust, out-of-state real estate portfolio at such young ages. And sure enough, 2 weeks later, I attended a Marshall Reddick seminar with him to go over some, real estate basics, and boom, I was hooked. 3 years later, I'm friends with the owners, and I'm a client of theirs, and I'm a very happy client of theirs. To give you a little bit more about me, some of my goals when investing in real estate, they were my goals starting out, and they're still my goals today. To purchase long-term income properties, to give, I want to be able to give both my girls each 5 pieces of fully paid off real estate by the time they're 40. And I know that's a pretty round number, but I figure if I have that goal in mind, I'll make it happen. I also want enough real estate on top of that to cover me and my wife's personal residence, retirement, and living costs when we decide to stop working, whenever that may be. I'd say these are my goals, but really, there are goals, my family's goals. And I know goals aren't fluid. There might be some reasons why we do not hit our goals. One could be we didn't use Marshall Reddick as our broker, wink, wink. But maybe, and honestly, maybe we didn't earn enough money to or save enough money to purchase the amount of properties we originally intended to. And that would really be our fault and our decision, in our control. Maybe we decided, halfway through this, we had enough real estate. We were happy with where we're at. And again, we decided, let's just stop and live our lives comfortably. Another reason, and a reason outside of our control, for not hitting our goals, would be, some unforeseen catastrophic events. This can include economic downturns, like the one we saw in 2008. One of us passes away, or becomes seriously ill. We get divorced. That could happen. Or lastly, there's a global pandemic. Who knows? In the event of an unforeseen catastrophic event, are we liquid? Meaning, do we have enough in reserves to get through one of these hardships? As you know, most real estate portfolios are not super liquid, but as smart investors, we should have enough cash and reserves to cover missed rents, hold on to our real estate assets if they're being devalued, and hopefully hold on to them until the value goes back up. I mentioned at the beginning, I'm a mini real estate mogul, meaning that if something major happened to me or my wife, we would need the extra help. My wife may not qualify for or be able to afford the amount of finance mortgages I may leave behind, and vice versa. If something happened to both of us, of course, our children would not be able to take over these assets, at least just yet. Not only that, but I were to pass away, and I like to kill myself in these scenarios because otherwise my wife would be angry at me. But if I were to pass away, and it was during a major economic downturn, like a global pandemic, would it be the best time to sell these properties to take care of, some personal needs? We know that over the next 30 or 40 years, or we can at least assume that the value of our properties will go up. But in the next 5 years, there's a chance they may go down. So are we so leveraged that my family, cannot keep the properties we work so hard to collect if they're forced to sell them below their potential value? We are doing this, we're building this portfolio as part of our long-term generational legacy. I always tell people I learn more from those that I've seen do wrong than anyone else. So, I remember I had a mentor once tell me not to buy real estate and to rent and to invest the rest of the market. Let's just say he's no longer a mentor of mine, and just went down the wrong path that I don't want to get into. Another one is people who say they could have bought, I hear this all the time from older generations, dad's friends, things like that. They could have bought an acre in Newport Coast for $100,000, let's just say. I don't want to tell my kids I could have bought property then. I want to tell them I did buy property back in the day when it was at a much lower value. But in buying and planning for the next 30 plus years from now, we would be wise, my wife and I would be wise to protect ourselves and hedge against any unforeseen risk. And that includes life insurance. We can easily and inexpensively cover some of our, purchase debts, future potential income, cover estate taxes, potentially, if our assets become that high, if estate tax law changes, we have to make sure we can cover our debts and our risk through some sort of life insurance planning. Most importantly, I guess, once you place the coverage in force, are you designating the distribution correctly? If proceeds are being passed directly to the next generation, you could potentially see some issues. So, another valuable lesson I learned of what not to do was something I learned in my early 20s. I had two good friends who's their father. Their mother wasn't really in the picture. And when their father passed away, he left them about $400,000, if I had to guess. And I wasn't too sure if those proceeds came from life insurance or his retirement account. I'm not too sure about that, but I knew they got about at least $200,000 each. Not a huge amount of money, but I know at the time they could have probably paid off the house they and their father lived in, or at least a large portion of it. The first thing they did was pay for a $150,000 backyard renovation, included a swimming pool, a putting green in the front yard. I think they bought a couple of new Camaros from what I remember. Just a ton of unnecessary things. They also both stopped working for a bit, which I give them a little bit of credit for. Their father just passed away. Their mother wasn't very involved. So I could see them wanting to take some time off. But what I didn't know at the time, and what they certainly did not know, was they would eventually have to refinance their father's mortgage. And so a couple months later, they had to let go of the house. They ended up moving to the Midwest, and I haven't seen them since, to be honest with you. Payments going direct to the next generation, especially a young generation, can cause some issues. So we usually suggest that our clients designate how they want their funds to be distributed through a living trust, that they have a long conversation with their spouse or their kids and their estate planning attorney on how that money is supposed to be used if something were to happen. And I think it's important that when you're working with an insurance broker, you find someone that pushes that part of the conversation. It's just as important as having the money in the first place to go to your beneficiaries. So that's my 2 cents on that. Now most people that take out mortgages or refinance their home, they'll usually receive some sort of letter in the mail coming from the mortgage company saying this is urgent, you have to buy this mortgage coverage right away. That's basically life insurance. Life insurance that's covering the amount of the mortgage, depending on what life cycle you're in. So year one, obviously, it's going to be covering a more significant amount of that mortgage or in total cost than it is at year 25 because the mortgage has gone down over those years. What people don't realize is they can usually shop for plans with major carriers and buy a lot more coverage for a lot less money. These are usually over-cost plans. And I encourage, if you're looking at those or if you have one, to also look at the larger market of insurance policies out there that you can buy. You can also create your own cascading coverage by purchasing different layers of insurance. I'm gonna use myself as an example, and the amounts, don't worry about too much. You're buying a number that's specific to you and your portfolio. But this should give you a general idea of what this means, this cascading coverage. So I currently, like I mentioned before, I have an 11-month-old, I have a 3-year-old, and a ton of finance mortgages. So I have $1 million in a 30-year term, which means in 30 years, that $1 million of coverage, if I don't pass away, will expire. I also have a 20-year term of $1 million, so that in 20 years, that amount will expire. Lastly, I have $200K of permanent insurance that will last until age 121. So I have it forever, as long as I keep paying the premiums on it. Just so you know, I pay more just for that little piece of permanent insurance coverage than the $2 million of term coverage combined. So a lot of times it makes more economic sense to buy the term insurance coverage to cover you while you're paying off these mortgages while the children are young. And I'll give you an example why. So the reason I structure it this way is so that while my children are young, the next 20 years, combined, all those policies combined, I have $2.2 million of coverage in place. Once they're in the early 20s, that 20-year term of $1 million will drop off, and then I'll have $1.2 million in coverage until they're in their early 30s. Once that 30-year term drops off, Hopefully, our real estate portfolio has grown to the amount where they don't necessarily need the full amount of the insurance I had in the past. But I still have that $200,000 of permanent insurance in place to cover any final debts or expenses I might have. Now, obviously, this may change, and I hope it does change throughout my lifetime, where I will need to buy more coverage because that means I'm buying more real estate. I need more protection. And so you kind of have to be flexible with it. The second type of coverage I wanted to go over with is long-term care insurance. And for those who have witnessed a family member going through in-home or skilled nursing care, it's easy to understand. They know how stressful and devastating long-term care can be on a family and the family's financial well-being. This is in my mind is a no-brainer as it serves two populations. With life insurance, it feels good to protect your family so that after you pass on, they're covered. But with long-term care insurance, you're the one actually getting the benefit. You're still alive while you're on claim. And just some facts, most people going into long-term care facilities will spend 3.5 years there on average. If it's a cognitive impairment like dementia or Alzheimer's, the average stay is 6 to 7 years. And in the state of California where we're at, that monthly cost for a private room is easily $6,000 to $10,000 a month. So this could really wipe out any legacy planning you had, and even worse, any retirement or real estate portfolios your wife or your spouse uses to live off of. In doing what I do, I work closely with many certified financial planners. They agree that for protection, it makes more sense to take a small portion of your portfolio to protect the larger good. There's all types of policies out there. There's what we call traditional long-term care insurance policies, and they're almost obsolete these days. They have increasing premiums. You pay it for the rest of your life, and it's a use or lose it structure. Meaning if you don't use the long-term care benefit, once you pass away, it just goes away. The newer policies called hybrid long-term care insurance policies are what I call no-loss policy. The premiums are large. They're not small by any means, but someone will get the funds you paid into it at some point. Meaning you will either receive them in long-term care claim benefits. You also have access to the money you put in. Sometimes 100% of the money you put into the policy you can take back. Decide I don't need the coverage anymore, or maybe you have a great real estate opportunity. You want to take the money out and purchase something at a great deal. And then there's also a death benefit aspect to it that is usually equal to or more than the premiums you put in there. So that's why I call it a no-loss policy. Someone at some point is going to collect the money you put in, whether it's you or a beneficiary. The real cost to these policies is your opportunity cost on the premiums. But the way I like to put it is if you took 5% of your portfolio to protect 95%, and on that 5%, you just simply don't earn interest on it, I think it's a great strategy because the overall protection is huge. To go into what's underwriting for these types of policies. If you've ever refinanced a house or taken out a mortgage, the underwriting on these policies is about 1/10 as painful. For long-term care insurance, carriers are not requiring medical exams. So there's no one in your house. You don't have to pee in a cup. They're not taking blood from you. It's basically a 30-minute phone call, an interview to go over your medical history, general risk. They may require medical records from your physicians. It's fairly easy. They can come up with an answer for you within a week sometimes. For life insurance, carriers have expanded their non-medical exam limits. Most these days will go up to $1 million. Some even 3 million. This COVID-19 outbreak, we're even seeing some carriers going up to $10 million in coverage without requiring a medical exam. It just makes sense. You don't want someone in your house that was taking blood somewhere else in a half hour going to your house. So a lot of people are worried about having someone in their house. Well, we can get a lot of coverage now with potentially not having to go through that process. So how can you find the best insurance options and services? Make sure your broker is shopping A-rated carriers. Our firm, we're fortunate enough to see enough business coming in that we have a good pulse on which carriers are easier than others on underwriting for certain medical ailments. Change constantly because carriers are constantly changing how much risk they're willing to take on. They're constantly changing how much reinsurance they need to purchase. Some carriers are fully reinsured, so they don't take on any risk. So it's good to know which carriers are better at underwriting and accept harder to underwrite individuals. The broker providing you with accurate quotes. Make sure they're giving you quotes that are specific to you. Make sure there's pre-shopping any medical ailments, any risk adverse reasons they should, if you're a professional skydiver or, maybe you got a DUI a few years ago. There's a lot of different things that go into underwriting. So you want to be open with your broker. You want someone that's on your end, because at the end of the day, they want to get this coverage in place for you. And it's good to find someone that cares about not only getting the coverage in place for you, but also someone that's going to make sure you're getting the best coverage for the lowest amount of money. One of the biggest, I see this all the time, and I just don't understand it. Is your broker coaching you on underwriting? Are they telling you how to prepare? Are they coaching you how to prepare for the medical exams, phone calls with the carriers, the do's and do nots? We send our medical exam tips to all of our clients to prepare them for what to do. Don't drink coffee before your exams, what time of day to take your medical exam, what to eat, what to drink, what not to drink, what not to eat. A whole list of things that, we've learned over the years can adversely affect the underwriting outcome. One's a big one, for example, would be taking protein powder. It's not a bad thing for you. It's actually probably good for most people, but your liver can only process so much protein at a time. So when we're taking labs, it looks like your body's not processing a normal amount of protein, even though you're just taking in too much protein through protein powder, things like that. Things that don't affect you adversely, but show up bad on the exam. So this is something a lot of brokers aren't doing. We provide this for the general public too on my blog. Is your broker negotiating on your behalf? There are countless times we've gotten better rates just by asking the carrier to make exceptions for us, especially if it's something simple like slightly higher blood pressure, or if someone's a couple pounds out of the preferred underwriting range. All it takes is asking, and sometimes we get great outcomes. And I think most importantly is go with your gut. Find someone you can trust. It's not very hard to get an insurance license, so we have a big population of insurance brokers out there. So find someone you can trust. Find someone that's referred to you by someone you trust, and again, just go with your gut. Everyone can reach me. I think my email is going to be put below. If you have any questions, private questions, concerns about your current policies, or need anyone just to take a look at what you have, I'm happy to do so. And feel free to call me or email me anytime.
Thank you so much, Bijan. It was a pleasure having you on. Lots of great information today from both Bijan and Shannon. It was truly a pleasure to do a presentation with you guys, and we greatly appreciate your time. I also want to touch on what we do now. So for all of you clients who are out there and are thinking, wow, that was so much information, what do I do? If you have anything additional and you've typed into the question panel, we have run a little bit over the time that we like to keep these webinars to, but I promise we will get to all of your questions. We will make sure that everybody gets all the info and details that they need. And in addition, if you are looking for a little bit more guidance and would like to get some advice on where you think your next steps should be, you can schedule a consultation with me. We can talk real estate. We can get you hooked up with Shannon or Bijan or both of them if that's the course that feels appropriate for you. And if you're just not sure and you want to bounce some ideas around, please don't hesitate to reach out. Here is my contact information on your screen. That's my cell. You can call or text, and my email address, of course. And you can also schedule a consultation online at marshallreddick.com/consultation. And if you do go the online route, just make sure if you have the option to ask for me personally. Otherwise, you'll be directed to one of our other wonderful real estate advisors in the office. Again, these are the things that we'll cover on your consultation. I loved earlier, Bijan said, these are my goals, but I really do think that everybody's goals are quite similar when it comes to real estate, when it comes to building a portfolio, when it comes to protecting your empire. So we all work together very closely to ensure that our clients' best interests are taken care of and to make sure that we're really setting you guys up for success in the future. So let us know what we can do for you. When is a good time? We can set up conversations via email. And again, this is ultimately what the goal is. I'm sure Bijan has something that looks similar to this that he could put together a roadmap to for his investment history. And you know, we practice what we preach, and we're really here to share our experiences and help guide our clients through whatever they need. Again, I really want to thank everybody for joining us today. You can connect with us on social media. I know a lot of our clients are working from home these days, and we're glad that you were able to share your lunch break with us. And we look forward to connecting with everybody in the future. Again, we'll get everyone's questions answered either later on this afternoon or at the very latest tomorrow. And finally, I want to thank our guests today, Shannon and Bijan. Again, it was such a pleasure, and we thank you so much for joining us.
Thanks for having us.
Thank you.
Have a great day, everybody.